Let me begin with a simple observation. Many intelligent investors quietly damage their long-term returns, not because they choose bad investments, but because they try to time the market. And the difficult part is this. It usually feels like the responsible thing to do. Today, I want to show you 5 timing behaviors that may quietly reduce your investment results. There is a good chance you have done at least one of them recently, possibly without even noticing. This is not about intelligence. It is about control. You may recognize this pattern. Markets fall. You wait for things to settle before investing. Markets rise. You hesitate because you feel late. Markets move sideways. You delay because you are unsure. You tell yourself you are being careful. What you are often doing is waiting to feel certain before acting. The difficulty is that certainty rarely arrives in financial markets. If you wait for clarity, you often invest late. If you react to fear, you often withdraw early. Timing feels powerful because it feels active. Automation feels boring because it feels passive. Yet over long periods, behavior usually matters far more than timing skill. I realized this personally during a period when markets looked unstable. I delayed several contributions because I wanted things to become clearer. Eventually, markets recovered. Clarity never arrived. I had not lost money, but I had lost participation. You may recognize this situation. Perhaps you have cash sitting on the sidelines, waiting for a better entry point. Perhaps you increase contributions after strong rallies, because confidence is high. Perhaps your investing pattern changes, depending on how you feel that month. There is a useful analogy here. Think of investing like planting. If you only plant when the weather feels perfect, you will miss seasons. A system plants consistently, regardless of short-term conditions. Later, I will explain the most overlooked part of automation. Interestingly, it has less to do with technology and more to do with identity. The first behavior is investing only when you feel confident. Confidence tends to rise when markets rise. Confidence tends to fall when markets fall. This creates a subtle problem. You invest more when prices are high. You invest less when prices are low. Or Cepheal alternative is to link investing to structure rather than mood. For example, you might decide that 15% of your monthly income will be invested automatically. That decision is made once, calmly, not renegotiated every time markets move. The second behavior is holding excess cash while waiting for the perfect entry point. Holding some cash for liquidity is sensible. Waiting for perfection usually is not. You may recognize this cycle. You wait for a correction. The correction arrives. You expect a deeper decline. Recovery begins. Now you feel late. The cycle repeats. And what quietly suffers is time in the market. Now here is the part many people underestimate. Automation is not just a tool. It is a decision about identity. If you still see yourself as someone who tries to outguess markets, you will override your own system. You will pause contributions. You will wait for the right moment. But if you see yourself as a systematic investor, something changes. Consistency becomes the objective. Execution becomes the metric. And short-term market movements begin to matter less. Automation is not about laziness. It is about discipline. It removes the need to make the same decision repeatedly, under emotional pressure. Let us summarize this clearly. Avoid investing only when confidence is high. Avoid waiting for perfect entry points. Avoid increasing contributions only when markets feel safe. Avoid adjusting allocation emotionally. Instead, build systems that remove timing decisions from the process. Automation does not remove control. It redefines it. Control in investing is not predicting markets. Control is designing behavior. If this perspective resonated with you, comment the word automatic. It signals a shift from reacting to designing. And if you value calm, structured approaches to building long-term financial stability, consider subscribing. In the next video, we explore something closely connected. How to build an investment allocation you can actually hold when markets become uncomfortable. Because understanding that changes how you behave when it matters most.